All right, let's get a move on and connect with the management of Teamlease to talk a little bit about their quarterly numbers as well as the impact on the jobs market as things have started opening up gradually. Ravi Vishwanathan, he's the CFO of Teamlease Services and now joins in. Ravi, thanks so much for taking time out. Clearly very tough for the jobs market over the last few months. Take us through how you've seen the overall slowdown in jobs impacting your business, and is there signs now of stability returning?
We began the year on a pretty, sticky wicket with actually, continuous job losses between Q1, which actually continued into Q2 as well. We did see, and this was on expected lines. This was completely on expected lines, and so we've been. So we've kind of been seeing some kind of revival, though not across the board. I would say it's been more.
Okay. Let's also talk about the outlook on your margins then, how your individual business segments have shaped up and what the outlook is when it comes to your operational numbers.
So actually, you know what really happened was we realized that we really, under the present circumstances, one cannot predict the future, but we can actually make ourselves worthy of it, which is what we did from April. We have done a bunch of stuff, whether it is on headcount, whether it is cutting down on certain business lines like the permanent recruitment business, and getting into newer lines of activity. Getting into more profitable lines of activity, like specialized staffing business. So these are some of the things that we've done. We've given up a lot of office space, the benefits of which will start kicking in from Q3 onwards. Actually, even the headcount, some of the large headcount kind of rationalizations that we've done, the benefits actually will really be kicking in from Q3 onwards. So we've done a lot of stuff to make ourselves fit for the future. And I think that will actually hold us in good stead as we get into it. Staffing, again, as you've seen, the productivity ratio, our productivity has actually improved. The margins in specialized staffing services have actually improved. Overall, I think we had alluded to the fact that we will be able to take the company back to the 2% margin by Q4, the 2.1% margins by Q4. And I think we are on track for that actually for this year. And hopefully, with the economy kind of opening up, I think we should probably see a better year in 21-22.
Also wanted to understand if you could give us an outlook segmentally for the company with specialized staffing. One is wondering, is that going to really continue to drive growth for you?
It will drive margins for us for sure. The growth for us will still come from the general staffing business and businesses like the NetApp or the apprenticeship program. But the margins clearly our improved margins will come from specialized staffing. Not that the specialized staffing will not grow. It will continue to grow. But given the current size of the specialized staffing business, I think it will be more of a margin play from specialized staffing. It will be more of volumes from general staffing. And general staffing will also improve its margins. And with NetApp, the apprenticeship program also turning around in Q2, I think overall it augurs well actually. A School Guru, for example, will turn profitable. So overall, I think that's looking pretty good.
Sure. Also wanted to understand if the cash on books and the operating cash flows are adequate to meet the debt servicing obligations that you have.
We are a debt-free company. We don't really have any debt other than normal working capital related facilities. We are a debt-free company, and we do have, and the cash that we generate quarter after quarter, and the current cash position, we're looking for to be used in acquisitions actually right now. So we don't really see a problem as far as cash balances are concerned. We still have a fair amount of tax refunds that are due to us, which will keep coming to us at periodic intervals. And I think overall, the cash position seemed to be much more comfortable than what we were when we closed March 2020.
All right. Thanks so much for joining us then and talking us through that, Ravi.